Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Thursday, December 16th, 2021. I want to do one more, stepping up my frequency of market updates because of the expanded volatility. Again, as I've said recently, this is when traders, both active traders as well as swing traders or typical trend traders, can really make some money during a steady slow grind up. That's where investors, that's the realm of investors or trend traders. You're doing well in your 401k, things like that. But when volatility starts to expand, there's opportunities for both active traders getting in and out long short, as well as swing traders, because typically this expansion in volatility, which coincides with a spike in the VIX, is indicative and often accompanies major corrections in the market. I don't have it here. You can do it yourself. Overlay a chart of the VIX. You don't see the VIX do this without stock market corrections. These are all corrections. And then every now and then, one of these seemingly little spikes in the VIX and little corrections, the market turn into this. That's what happened when COVID hit. That's when the S&P 500 fell 36% in a matter of weeks. So that's what I wanted to talk about today, and just again do a quick update on where we are in the market. So let's talk bigger picture, kind of medium-term picture is a daily chart. We are still smack between the levels I've been highlighting recently, about 401 at the top. Again, you had one of the best shorting ops in years. I mean, it probably the single best shorting op for in a one-day period. Remember, we don't have the pre-market trades turned on here. We hit that 401 to the button this morning. I mean, right at it, within a few pennies above it or below it. I think a few pennies above it, and gave you again one of the best shorting ops, because if you shorted that this morning into the lows today so far, the S&P, or I'm sorry, the Nasdaq 100 fell 4%. So let's talk about where we are now, what's going to happen. It's the beginning of the video, so I'll just say it. There were a few levels I pointed out today where we could bounce. We bounced on the first one, went through the second one, but I think we'll bounce again because we already have reversed. That's why I wanted to start the video. I started to get this ready when we were down 3%. 3% to me seems about the magic number when we're not in meltdown mode, which by the way, we're not. We're just, again, we're in a sideways range chopping around, volatility's high, but for years it seems that 3% is usually about the daily limit, not on the button, but roughly there. Rarely do you see a 4 or 5% drop unless the market is in meltdown mode. What I mean by that? That's what we saw back in we saw it when COVID hit. We saw it back in the fourth quarter of 2018, and we saw it a lot during the bear market of 2007 to 2009. So number one, that's usually when, if you are an active trader, that's when you might want to consider booking some profits on your shorts and maybe even getting ready for a bounce into the close. I'll probably gobble this up, but let me again speak to the bigger picture here. And I said it this morning too. If you're not an active trader, that's not your cup of tea. Don't try to start learning active trading now. Stick to your guns. If you got to, we're able to add to your shorts or re-enter shorts or take a new short today around 401, then I think you're looking good right now. It's the same thing I said this morning. Just keep your stops above there. I wouldn't lower them now because we may make another run at it, but there's nothing wrong if you want to lower it because we got rejected there once again. And sooner or later, I think the recent lows about that 380, 280 level is going to give way. All right, but let's talk about that's it. Well, I think I said it. There it is. We're between that key 380, 280 support and the 401 resistance. And it's still anybody's game. Maybe they come in and do this now, pop it. Nothing's changed from my last outlook, my last update. I don't think we're going to break this today. It is possible, but I doubt it with now a little over a half hour to go. But I gave you my swing targets before, and again, you can reference some of the older videos to do that. You just go in, let me show you how to do that. Go in here and go into the site, and there's a couple ways to find market analysis if you're trying to catch up. You can go to market analysis here, all asset classes, and then click on equity market analysis. And what that's going to do, it's going to load all posts that all posts that are related to or coverage with the broad markets. You might have other things mixed in, precious metals, crypto, but every post, again, so you want to go back in time and look at, let's say, that recent post on the breadth indicators, stock market breadth indicators, that's going to be there. And the other way is use these symbol tags. All these symbol tags that I put below a post are hyperlinks. They'll load up, they'll queue in posts related to any particular security. For example, you trade silver. Click on the word $silver. That's for those are silver. That's the chart of silver futures, a long-term chart. You can also click on /SI, which is also silver futures right there, and that's going to queue up all posts, load them in chronological order that have coverage of silver in there. Okay, so let's get away from this for now. Those are the levels to watch. Trade it as you want, but again, break of that level should open the door for more downside. And just kind of recap the levels that are likely to be hit. We have an uptrend line right here, 373.14. And again, this is on the daily chart. I have different targets on weekly and 60-minute charts, but 360 and 360 remains what I call my preferred swing target. Right now, I think that's where we're going to go down to if 382.80 gives way, clearly breaks down, or the recent lows that we had that we dipped below there the other day. And so, you know, if you got a short off this morning at 401 or any of the others, remember we had multiple short entries there. That's going to take us down about another, about 10%. All right, so 60-minute chart. Here's what it looks like. I added a potential trend line here, and that's about what we hit today. So we have this little 60-minute symmetrical triangle pattern going there. And remember, on the 60-minute time frame, I still have these targets here: T3, T4. We already hit T1 and T2 a while ago. But here's what I want to talk about: the bigger picture now. And let's zoom all the way out to the monthly chart. And so this is something I've covered in the past. I have the PPO histogram. These are the green and red bars here. And you have the way it works is the zero line right in the middle. It shows you when the PPO line crosses down below the signal line. And as I've talked about, covered this one recently, and I need to say it again, the month is not over. This is a monthly chart. All that matters is how we close, but we, as of now, unless the market can turn around and rally, and probably have to get up above the previous highs by a decent amount, because we flipped. These lines have crossed. That is a bearish crossover. Again, we will know definitively if that crossover sticks, because the way it works is a histogram. This is evolving and changing, and so if we drop for the next 2 weeks, before the end of the month, that histogram is going to become more red. If we rally, it could get back and close back above there and stay green. But as I've told you before, usually when you see these hills start to cross, go down, momentum's waning in the market. And most importantly, every single one, with zero exceptions, we can go back over 2 decades. That's what I'm rolling back to now. I'm going into the 90s. And without any exceptions, each and every one, even the little blips of these bearish crossovers in the PPO, each and every single one has been associated with a correction range. And I'll just read them out. Again, this is the Nasdaq was 31%, S&P 500 was more. That was that one little bar, and that's because we fell so hard so fast. It was, again, well exceeded the technical definition of a bear market, a drop of over 20% off the highs. But the Fed also came in, and it's what I call Ursa interruptus. They interrupted a bear market that would have had a lot and should have had a lot more to go, and came in with the absolute nuclear option. It made it, made 2008 look like a walk in the park. All right, so I'm going to read them all out. 31%, and these are, I rounded off. I rounded each one off to the nearest percentage. That's from high to low that occurred around those times. 26%, 13, 16, 55, 18, 84, even back in the 90s. These little blips, they don't look like much. That was about a 29% drop and a 20% drop. So there it is. And again, nothing's 100%. Maybe we close this month with a red histogram, and then market continues to do that. Certainly can't make any guarantees, and I can also tell you that I don't have any of my long-term indicators flipped to bearish yet. They're all still bullish right now. I'm talking monthly time frames. But you do have that key 40-week moving average, and that's a likely target as well for a pullback. Depending on if and when we get there, it'd be about also, about a 20% drop. So 20% is really, I think, a good number right now. And the takeaway from this video, and this is something I've warned of before, be ready, because if it happens, I think market conditions are ripe, as I've been talking about for weeks. With breadth indicators and divergences on all time frames going out, some of the long-term indicators like that one on QQQ I just showed you starting to fire, still not confirmed. This is when the market conditions are ripe for a very swift and big correction. Now, I know somebody made a comment the other day, yeah, Randy, go back to 2018. You've been saying, you say that a lot. Yes. I can tell you this, haven't missed a single correction that's come. When you're in an uptrend, just like when you're in a downtrend. When we're in a downtrend and it's getting extended and I start seeing divergences bullish, I'm looking for a bottom. When you're in an uptrend, and I'm a trader, a swing trader, I'm looking for pullbacks, corrections to trade. I'm also on the lookout for a much bigger top to position for a position or a trend trade to catch one of these, or the next bear market like this. The amount of money that would put in your pocket to capture most of a 55% drop, or even a good chunk of it, or get out of your 401k, because I know I got a lot of emails back then. Hey, what do I do? People freaking out, and most people unfortunately sold out near the bottom. So now where am I going with this? All right, so along the way we get corrections. We trade them. And that's quite often the top that you get lately in the last few months off sell signals that I've gotten on the 60-minute time frame, and that's most of what I've been talking about. This time around we had some sell signals fire on the weekly. We had a bearish engulfing candle. We had trend line breaks, and depending on how this week finishes, we may have a little more visibility to where we're going from here, or we may not. But here's what I want to talk about: the warning about a potential for a swift drop that let's just say would be anywhere from 10 to 20% right now, possibly more, but let's just talk about that range, and why I continue to bring that up when I see market conditions the way they are. So the reason is this: I did a post years back, and I used the analogy of warning about things that might happen in the market, and comparing that with hurricane watches and warnings. I think I've lived in Florida my whole life. I'm second generation Floridian. My parents were born in Miami before me. I've lived in Miami half my life, and out on the west coast of Florida the other half. And I've seen plenty of hurricanes, or at least a lot of hurricane, close calls, and been through a couple. And what I wanted to point out here, and this is what I mentioned that post years back, is the difference between a hurricane watch and a hurricane warning. So for those of you that are out west and deal with the tornadoes, things like that, I think you have the same thing. I think there's a difference between a tornado watch and a tornado warning, but I'm just going to use this one. And now the difference is, okay, so a hurricane watch is means that hurricane conditions are possible within a specified area, and they issue that 48 hours in advance of the when the hurricane might hit that area. Okay, and over the years, oh goodness, I can't tell you, can't even count on both hands the number of hurricane watches have been issued, where I live, and almost all those didn't hit. I can pretty much one direct hit in the last 20 years. I'll talk about that in a second. And now the difference of a hurricane watch and a warning. A hurricane warning says the hurricane conditions are expected in your area, and that means likely. And so right now we still have, and this is what I've been talking about for the last couple of weeks here, what I would consider a hurricane watch for the market. It means the conditions are possible. Let me expand on that one a little bit more. During normal market conditions, which is 80, 85 plus, maybe 90 plus % of the time, especially for the last 10 years, we don't have those conditions. if I'm pointing out a pullback trade in the market on a 60-minute time frame, it's probably only a 5, 6, 10, 12% drop I'm looking for, and then cover your shorts and move on to the next one. But over a few times over the last few years, I've talked about this. I know one of those was back in that big fourth quarter drop in 2018, and warned of those conditions. And so we have those conditions now. We're coming off extreme bullish sentiment. The fallacy that the Fed will not let another correction happen or another drop, that they're going to stay easy forever. Extreme, or pronounced market deterioration in the internals, put to call ratios, all those other things. So that really increases the odds that you can get one of those big swift drops in the market again, 20 plus percent. And if we start to roll over on some of my longer term indicators, and we start to firm up those sell signals we got on the weekly charts lately, I see some trend indicators and key support levels break, especially on the daily and weekly charts, then we may shift over to what I would call, a hurricane warning for the market. And and if that happens, again, the takeaway and what I'm trying to do here, because I've noticed a lot of complacency. I don't know if it's just a quiet week. Holidays are coming up. But I think it seems like a lot of folks are probably either not trading or not interested. I'm not usually the amount of comments pick up when people start to engage a market. I'm not seeing comments. I don't know if there's a problem with the comment button, but the last couple of days, I would think, especially with the Fed yesterday, that big rally we had, the reversal today, I think there'd be a little bit more activity. And I think people have probably maybe just coming a little tone deaf to the whole, hey, be on the lookout. We could be on the verge of the next big drop. And again, that's where the money's to be made, and you have to act fast. If you wait until it's too late, you can roll back here, and you can look at what happened back in. We had sell signals back there when COVID first hit, and if you waited just a few weeks, guess what? You missed. If you waited, a month or so, you missed almost the entire move. And the same thing to get out of your longs. If you were complacent back then, and a lot of people got hit hard on that. Same thing here. So a point I'm trying to make is stocks tend to fall a lot faster than they rise, and it is the norm that the stock market will often in weeks wipe out not just months but often years of gains. It did it here as well. It did it in 2018. It took you back, took the Qs back to where they were back in middle of 2017. So that's it. I just wanted to again impress the fact that we have a lot of those conditions. So again, to use that analogy, the market's on a watch, a potential watch for a swift move, and that could quickly shift to a hurricane warning. And if you've lived in a state prone to hurricanes, you get a hurricane warning. I think a lot of people have become. I know a lot of people have become complacent. I know I love the markets. Been studying them for decades, and that's what happens time and time again. After a while, they think it's the boy who cried wolf. Those warning signs. Sure, there's divergences, Randy. Sure, there's high put to call ratios and everything else like that, or low put to call ratios. Takeaway is this may be another pullback buying opportunity on the road to new highs. Just be ready if it's not, because if you're not, whether you don't short, you don't have any interest to, and you're long your 401k, I haven't seen market conditions like this in years. Not even back in 2018, not even back when COVID hit in 2020. It's been the closest analogy to this that I can come up with, and I've seen some people that I respect, is either the dot-com era or even 1929. Seriously, with a lot of the market conditions, both not just technicals but fundamentals as well. So right now everything's zinging along in the economy fine. We know that retail sales are up, consumer confidence, well, stock market's right off all-time highs. So that's why you can't get uber bearish right now. But again, don't underestimate how quickly the tide can turn, not just the stock market, but sentiment. Consumer sentiment and market participant sentiment goes hand in hand with what this is going on here. And if you drop, you know, 10-20% in the matter of a couple weeks, all of a sudden you're going to see things change pretty quick. So that's it. Let me just move on. Let's talk now about the very short term, and then I'll give you, one other. I want to do an update on crude oil. I think that's timely right now. So let's just talk about yesterday real quick. And so what we're going to do here, remember the Fed announcement was at 2 p.m. yesterday, right? Right here. What I'm going to do is turn on these volume price histogram bars so you can see them a little better, and we're going to talk about what happened yesterday. All right. So, and this is I think this is a great lesson, whether you've been trading or investing for a while or you're new to it. I made a point to harp on it yesterday. I've done this long enough, and I've seen many, many, many big, important Fed meetings. And like I said, the initial reaction, I caution you, do not take the initial reaction to be the lasting reaction, because quite often it's not. And it sure wasn't. This was one of the biggest turnarounds. So I'm going to zoom in right here till 2 p.m. yesterday. And if you were, at home watching the markets, you saw that huge reversal. Fed announcement came out here. Well, that was milliseconds. That was a spike hit by the algos. So this is the initial reaction. We after 2 p.m., right at 2 p.m., we rallied. That's one of the strongest rallies. And remember, it continued into the pre-market today. But from low to high right there, from lows to the high, well, into the close, that is, about 3.36. Quite the impressive rally. And now all that's been faded. So here's the important part. I'm going to take this back. I'm going to park this indicator, just look at price, and look at what happened yesterday. So here's what it looked like if you were trading yesterday. You saw this rip up again over 3%, well over 3. And you can see what the volume price histogram bars show you is where people bought. And right now you can see that yesterday there was the initial those that bought in. See these bars down here? That's where a bunch of the trades occurred. So the bulk of the buying right here was really thin. These volume price histogram bars are thin, so not many people bought here, but a ton of people. These are what I call the JCLs, Johnny Come Latelys. They wanted to jump in. They didn't want to buy on the news. They wanted to buy price. They were chasing price. They were chasing the rally, so they bought in there. In fact, that was the bulk of trades yesterday. So they all occurred between here, from about 394.50 up to about almost 400, 398 right there. But then you go back to today and you see now, did I do this right? There we go. There it is. There's yesterday. You can see they've all been faded. So all these big trades that occurred right here on the volume price histogram bar, and again, that includes what happened this morning. And then even those that initially jumped on it, they're underwater right now. So this is how technical analysis works, at least how I view the charts. Technical analysis works because there's a story to be told. There's a story of where buyers overwhelm the sellers, where the sellers overwhelm the buyers. And so this tells me that everybody, individuals as well as institutions, that thought it was a giddy up moment because Powell came out just as dovish as he ever is. He's slowly turning, but in my opinion, others way too slow. He should, he's putting the country at risk here by letting inflation's rampant right now. It's at 40-year highs. Like I said a week ago, we had last week or earlier this week, the biggest increase on the PPI, I believe, in history. So you're seeing prices just rip up in the economy, and they need to put the brakes on that. Anyways, they didn't. So what happened is everyone thought, okay, that's bullish. He's going to just slowly. He's not going to raise rates now or anytime soon. He'll start raising rates next year is the expectation. And again, those people have been now put underwater. So all I'm trying to get at is if you want to micro analyze in the very short-term time frame, you can say this. Bulls didn't win yesterday. They had a big day, but remember, nothing. I made it very clear, nothing technically significant happened. It was noise. It was post-Fed noise, and we didn't break any resistance levels. In fact, they took it right up to that 401 level today in the pre-market, which you don't see here. But today, The bears won. They took it down and they wiped out all the gains that the bulls had made yesterday. And again, I'm speaking metaphorically. I'm not a perma bear. I'm not a perma bull. I'm just talking about supply and demand forces. So the seller's overwhelmed. And again, I would like to say one day doesn't make a trend, but you can see here, there it is on the 60-minute chart, that big rip, and you can see it clearly on the daily chart. One big fat green candle, followed by a big fat red candle. So it's like just bears answered today, and more importantly, again, this is why I like to watch the futures, because the futures tell a clean or round the clock story that you don't see on QQQ in the regular session. You can turn on those pre-market trades like I had on earlier, but we'll go to that NQ chart. This is it. NQ on Globex is around the clock trading, and there it is. So you can see again rejection there. The high was ever so slightly above that previous high, which just extended the previous divergence we had in place right here at that last high. So what you're seeing here is you're seeing a lot of selling. This is indicative of institutional selling. When you see these big rips, heavy selling like that, it's usually the institutions getting out. And yeah, so that's it. We're coming up on a big level right here, 15,536. That'll be the level, I believe, that if and when that goes, and I believe it will go, that's where things can get ugly quick. And so I've laid out for a while my if things get ugly target, and so I'm gonna have to drag this line and stop it here. If you took advantage today of that, once again, what I call a gift, nothing short of another gift on a pushback to this level, like all these other gifts that were pointed out before, and we hit that target, you're going to be looking at a swing trade of about 12% on the indexes, and I think that could be hit within a week. I think it could happen that quick. Maybe two, maybe it never gets hit. Maybe I've just spent 26 minutes talking about a what if that never occurs. But that's it. I'm going to leave it here, let you guys decide what to do. You have the levels to watch. Pretty much right now, the most important level is the break of the recent lows. We went just below that. I've had that 15,773 level there for a while, but you can see we had two reaction lows below it, about 15,738 or so. And the way this is probably going to work, I always give you my guesses. It's one thing to call the market where you think it's going to go, especially micro calls. It's a whole nother to try to anticipate how it's going to play out. But my guess is you're probably going to see a gap down tomorrow and or Monday if the scenario is going to play out. And what gaps do is they deny those that are waiting for the perfect short entry, they deny them an entry. We could gap down here. The futures are going to trade round the clock until Friday. They shut down and then they open again on Sunday evening. But if you're a QQQ trader, like I said, I think it's better to be short now, at least with a starter or half position, a fractional position. You can always add to or subtract that exposure, meaning if you gap down, you're already profitable, you can add to your short, and then you want to add again if a break of the trend line in 373. But once you start getting down here, it's not really objective. Then once you start getting close to the final target or the next targets, at that point you should be looking to where to cover those shorts and or reverse long for a bounce. Likewise, if you're short and all this doesn't come to fruition, we don't break down, then you need to decide where you're going to start scaling out. Are you going to take a tight stop or allow for a 3, 4, 5% marginal new high, or even more than that? But I wouldn't do much more than that. Let's just see what happens. I'll wrap it up here. Those are your key levels to watch. And again, I showed you some things that on that more significant monthly time frame. We won't know for certain till the end of the month, but by around Christmas time, let's just say we do break down and we head down and we come back to the 200-day moving averages in that 360 level, and with a week to go, we're down there, a week to go before the end of the year, and that histogram that I talked about earlier is solidly red, moved down even more, then the chances are you're not going to recover that within the end of the month, so you'll probably get this sell signal confirmed right here. And that's one of many. It's not a be all end all. It's got a pretty good track record, but also keep in mind that sometimes it's a quick one and done. And again, it's not a timing indicator. It's just associated with all these drops. So the takeaway that I tried to make in the beginning of the video, the minimum, the smallest drop for decades that we had on there that I measured out was 13% right there on that one. And then before that it was 16%, 18, and then every other one was 20% or more. All right, let's wrap it up here, see where we close. And well, no, I don't think I'll do another video. It's almost 4 o'clock now. So that's it. We'll pick it up tomorrow, see where we open and how we close the week. This is Randy Finney with Right Side of the Chart. Have a great day.